This is going to be more of a doubt clearing, where they will ask questions and answer questions. What they will expect is that we have a proper class. Yeah. It cannot be a class. You ask questions, I will answer. But don't expect that I will take a class or I take a PPT and go through the complete class. But that is a habit. Yeah. They will not watch video. Yeah. And today they will see whether you are taking the whole class. Yeah. Okay. After
your voice is not clear.
Voice is not clear? Is the voice clear better now? ये बोल रहे हैं वॉइस क्लियर नहीं है जो बोल रहा है इसको लगा तो फिर
उसमें क्लियर नहीं किसमें क्लियर नहीं
उनको नहीं आ रहा है वॉइस प्रॉपर्ली
थ्रू दिस और दैट लाइक
ओपन भी नहीं आ रहा है ऐसे भी नहीं आ रहा
तो अभी क्लियर आ रही है
अभी क्लियर आ रही है
हाँ अभी क्लियर है
Hi, good afternoon. This is Shorodip from Parent Academy. So today we will be discussing the doubts about the basic derivative section of the module. So I request everyone, if someone is having any question, please type your question in the chat and I will answer them one by one. again, I'm expecting for the questions. So please go ahead if you are having any doubts on the basic derivative module. I request students, so please type in the questions in the chat section. Whatever doubt you have, we can go ahead. Good afternoon, students. Please type in your question. This is Shorodeep, your instructor for the session. And I will answer whatever questions you have on the basic derivative module. Thank you. Hello, Wahid. Good afternoon. Are you able to hear me? Yes, because I am waiting for the questions. So please proceed with the questions. I will be happy to answer them. So this session is on basic derivatives, which you have learned. And please give me your questions. You can type in your questions in the chat box and I will take them one by one. Thank you. So, as there is some questions that is yet to start, so we will be starting our discussion on the basic Greeks that you might have learned into the topic. So, what are the basic option Greeks that we have learned in that are useful for our option trading? So when we talk about Greeks, the first come that what are the important parameters that decide the price of an option. So one is once we decided the strike price, what is most important is the price movement of the underlying of the derivative. It may be share, it may be a commodity, not in Indian perspective, but let us take example of a Reliance share. So suppose Reliance share is trading at a value of 1300. So what we require is that for each unit change, like suppose 1 rupees here, what would be the price sensitivity of the how the price of the option changes. Like for a call option, if we take a 1320 call. So suppose if from 1300 Reliance becomes 1301, the price of the call option would go up because the price of the underlying is getting near to the call option. So what will happen is we measure this change in price of the option per unit change in the price of the underlying, we measure it as delta. So when we are talking about delta, so when the price increases, the price of the option of call option increases. So the delta for a call option is positive. The same way, when the underlying price goes up, the delta is negative because the price of the underlying option goes down. And there comes, after that it comes the Greek that is important is gamma. Those of whom who know calculus a little bit, they know what is second order derivative. So I am not going into that. Delta, the rate of change of delta is called gamma. So suppose the Reliance price was 1200. The 1300 call was having a certain delta. Now Reliance become 1250. So as it comes near to the strike price, the rate of change of delta increases. So what is happening is that we measure that amount with the gamma. Then comes the theta, the third Greek. So theta is a very important parameter because what we know that options, if the buyer of the options, that what is built into the option is the intrinsic value plus the time value. So as the as the time goes on, the buyer of the option finds that the price of the option is losing value. So as it nears more and more towards the expiry, what we see, the decay gets faster. So at any particular point of time, there is a time that is remaining for the expiration. So the rate of change of this option price with the time is called theta. So for a buyer of an option, a buyer of a call option, buyer of a put option, the theta is negative. So suppose someone is shorting an option, like shorting a call or shorting a put. For him or her, the theta would be positive, because for that strategy, as long as the time is reducing to expiry, what is happen is that more and more the price of the option is going down. So the person who has shorted the call or put is making money. There is another important Greek that we will discuss is this is Vega. Vega is the volatility. So what is happening is that when we go to the NSE website, I will share the screen with you. One second. This is the NSE website. As you can see, we are going to the Reliance derivative. It is opening. So what I was talking about is that there is a certain implied volatility of every option at a certain point of time. Yeah, here we go. Now we will go to the option chain. So here you can see the Reliance stock price is 3022, and let us take the 3060 call. So here this column IV gives the implied volatility. So per change in implied volatility, there will be a certain change in the option price, because as the volatility goes up, the option price will go up. So the rate of change of the option price per unit change in implied volatility is called the Vega. And now we will move to the last Greek. So the last Greek is called Rho, and it is not that important in the context of Indian options, because in India we have options based on 1, 2 or 3 months, and normally there is very little change in option interest rate during this 3 months of time. But for a general knowledge perspective, the Rho is decides the per unit change in option price per unit change in interest. Suppose interest rate is right now 6%. It goes up to 7%. So what we have, the call option have the Rho positive. So suppose from 6% to 7% there is a movement of interest rate. So the call option prices would go up. Normally put options have the Rho that is negative. So what happens is that if the rate of interest goes up, the value of the put option goes down. So that's why it is this is a Rho negative. So that is not very important in Indian context, but we discuss all the Greeks that can come handy and useful when we trade an option. Thank you very much. So I discussed one topic. I request everyone to put forward their questions and I will answer them one by one. Thank you very much. There is a question from Jyoti. Hi Jyoti, good afternoon. The question is, I wish to know how does the price of the futures contract is affected by the underlying, not according to the formula, but in real market condition. Jyoti, it is dependent actually based on the formula only. But the factor is that in the formula, there are a lot of simplification. We don't consider when we have this formula that the future price, that is F, that is equal to S into e to the power RT. So that is the formula. There is a lot of simplification that we don't consider there is a transaction cost. We don't consider there is a borrowing cost. We don't consider that, okay, we consider there is a borrowing cost. We don't consider there is a transaction cost. We ignore if there is a transaction. So for some kind of a physical, suppose it is oil. We are talking about oil futures. So there is again a storage cost involved. So we did all these simplifications. So when in real life, suppose I will take shares and commodities separately. So when in real life we are considering for the future price relation to the underlying, we into the exponent part, that is e to the power RT, there other factors will come on. Like if there is a storage cost, we add that part to that exponent part. So a lot of things will come on, and actually this way they are related according to the formula only. Because otherwise, if that is not there, there will be always be an arbitrage opportunity. Because if there is a mismatch of price between the future and the cash, it is not related to the future and cash. So suppose selling a future and buying a cash is somewhere profitable, somewhere there is a mismatch in the price in the market. People will actually go for the trade and the arbitrage opportunity will close in. And suppose for a physical commodity of oil or gold, because suppose you are trading gold. So there is a gold, if you are buying a gold, there is a storage cost, there is a security cost, there will be taxes. So all these components are built into the formula F, into the exponent part of the formula F is equal to S in E or RT, that is the cash and carry model. We call this arbitrage model for this also, because it actually closes down whatever the arbitrage opportunity that will be available. Thank you. Please go ahead with the next questions. Thank you, Jyoti. Hi. So waiting for the next questions. Thank you, students. Please go ahead if you have any doubt on the basic derivative model. Hello, students. Please come ahead with questions. I'm waiting for them. Thank you very much. Thank you, Jyoti. You're welcome. Next question comes from Mr. Wahid Khan. Yeah. The question is how to identify gap up opening or options call or puts 2 and 3 days in advance, assuming the stock is going to rise heavily or fall heavily. Wahid, if I can understand your question, is that before 2-3 days you want to understand that if there will be a upsurge into the stock and there is an upsurge into the option premium, right? So I will say that there is it is related to the actually movement in the stock price or the index price. Suppose you are trading Reliance or any stocks, so or Nifty. So you want to guess if there is. So it can't be dependent for standalone as an option. You have to understand from your technical knowledge that technical study. You have to guess that okay, there is a breakout or there is a chart formation that the stock price can move very swiftly. If you go to the technical module, you will find many such breakout, like from ascending triangle, from head and shoulder formation bottom. So for a put, there is again a head and shoulder breakdown. There is a breakout from a flag, breakdown from a flag. And not only that, if you go to the candlestick charting that you will understand, okay, there a hanging man has formed, so there is can be a bearish engulfing pattern is formed. So there is a potential for market to fall down heavily from this point of time. So you will take a call that from the chart reading that okay, based on this on these formations, based on this that stochastics has turned down from overbought zone to the stock or the RSI is coming. So a combination of various indicators, you will understand okay, there is a probability, there is no surety. I am again saying that there is a probability that okay, the market can fall from this time. So 2-3 days ahead, before many times market will form a distribution is a pattern. So market, I'm going a little bit into the technicals because the question, though it is about the calls and puts, but it is about the movement of the market. So based on these things, you will understand that okay, there can be a fall or rise in the market. So based on that, you will have to buy or sell your strategies, buy an option or selling option at the initial stage is quite risky. So do that after you have quite a good experience in that, and then only to attempt that I would suggest. But for buying option, you have to understand for the price movement of the stock price. And again, there is a event related thing. Like a few years ago, Infosys used to be the bellwether of the IT. So what used to happen is that based on the way that Infosys results would come out, Infosys many days Infosys would move 10%, 15% on the either way, the bullish side or the bearish side on the result date. So people who used to buy calls and puts before the result announcement, that is another way. Suppose there is an election going on and market sees that if the election outcome is favoring a certain political party, whichever it may be, it will be the market sentiment would become either bearish or bullish anyway. So if you have a fair understanding of the way it is going to pan out, the market sentiment, and there can be a bullish up move or a bearish down move in the market, you can have a strategy. Or not only that, if you think there can be a very sharp up move and down move, you can go for a straddle, long straddle, you can go for a long triangle at that point of time. So based on this two kind of scenarios, one is technically you have to have an idea either, or maybe due to the kind of event situation there, you can go ahead with the strategies. But the main thing is that you need to have an idea, a conviction in which way the market is going to move. So that way you can buy and call. And the opening price gap up, because suppose the stock Nifty has opened 150 point up, the first trading price of the option or first 2-3 minutes can be a little bit noise also. So the opening gap up, it may, suppose market has opened up 100 points in Nifty, suppose a 200 points have a call option open 30 points up. So what happens is that even if market comes down 10-20 points after that, the option, because first 15 minutes were not actual pricing, people were buying and selling in whatever prices they were doing. So even after that market comes down 10-20 points, suppose there is a 300 point Dow, Nifty opens 100 points, even market adjusts in the fair pricing, and after 10 minutes, even markets come down 10, you might find a call at 40 rupees higher than the previous close. So that's the way market works. Thank you very much. So thank you, White, for the questions. I would request for any new questions. Thank you very much. Next question comes from Jyoti. Jyoti asks that what is the best way in technical analysis to predict the price of the stock futures in short term, like intraday or BTST or maybe 2-3 days holding? I will discuss in brief because this session is more on derivatives and basics of derivative. But Jyoti, actually it is very subjective. The answer to the question is very subjective because different people trade. So based on the money management, the trading personality, it is one way of trading or technical analysis suits another. One person, some people like to take into pullback trades if market is in trade, because always try to trade into the direction of the basic trade. So in that case, becoming right into when you trade, is the probability of becoming right into the trade is more. But when you talk about a very short term, because when a market is in a trend, it will be trend for 2 months or 3 months. I will show you a chart. One second. I'm going to the investing.com. In this website you can find simple charting free of cost actually. So, let us go to the Nifty chart. Now this 15-minute chart, as you can see, I will show you the daily chart. So if you can see that this that up move that is going on from almost January, beginning of January, right? Let us look at the previous, right? Here there was a down move that started and it continued from September to December, again 3 months. If you can go before that, this up move from March to again September. So what you can clearly see that a natural way a trend lasts for quite a 3 to 6 months of time. But suppose you are looking at something like a smaller period of time, like take this portion. Though the market was uptrend, this period of time market was going down. So if you are looking for a intermediate 2-3 days of time frame, it is always better to have in mind that okay, this is the primary trend, but always try to trade the intermediate trend when you are looking for a very short point of time. And I'm not talking about intraday, I'm talking about intermediate time, because here you can see, if I add some indicators also, you will understand. I'm adding Bollinger Band. So if here you can see that Bollinger Band is one of the indicators. The middle line is 20 SMA and this is one standard deviation away in the positive side and one standard deviation away in the negative side. So even the daily chart is in the up move, you can see the Bollinger Band is flattened. So at this condition, you can go a very strict short position with this strict stop loss. So again, I am mentioning these are for learning videos. So these are for learning. No, please take advice or conscious call before you invest in the market. These are for academic purpose. I am telling you, because as an instructor, we are not allowed to give any trading call. So here you can see in the daily chart, the Bollinger Band has flattened in this part of time. It is coming down. It is flattening. We can add one more indicator, RSI. So what we can see is that during this portion, RSI is coming from overbought zone. So combining in these two things, you can see that there is an intermediate downtrend, and you can look for a selling opportunity here. But in a uptrend, the kind of profits that the counter trends will give you is very less. But suppose there is a breakout. Here there was a wedge that is being formed, and when there was a real breakout in the price, Yes. Even if you entered here, the kind of money you make is higher. Here also you can see there was a small consolidation. So it is very difficult to make money against the major trend. But if there is a breakout, you don't need to trade every movement, right? So here, if you short the problem like here, so there is a probability that you may or may not make money. So these kind of trades will even out. Though you could make some decent profits like 9,500 to 9,000, 120, 130 point move. But suppose you enter here or here, a clear breakout, that time, even if you enter here, you are making a 200 to 50 point kind of a clear cut profit. So always try to select very small number of indicators. Like here I have selected RSI and Bollinger Band. You can select any other indicator that suits you, moving average, MACD. There are a lot of things. So just look at the major trend, try to see the price movement in the direction of the, when it is direct in the direction of the major trend, like in this case this is up move. You can see the stock price going up. You can make very rapid profit. Here see the kind of up move, the consolidation is a bit time consuming. Even if you sold here 800, 800, 8,800, how much could you got? 60, 70, but when the up move came, okay, you got 200. So try to trade in the direction of the major trend. If you, it is your call if you want to take these trades in which Bollinger is flattening. But this trade, frankly speaking, nobody makes a large amount of money through this trade. It is always better to trade in the direction of the major trend and wait for the breakout, or you can wait for the pullback. Use a Fibonacci pullback ratio. So a combination of things you can use, but again, you have to use something consistently. Do some paper trade in NSE Pathshala before putting real money into the market, and you can understand what suits you for short-term trading. Thank you very much. Jyoti, thank you very much for the questions. I hope I have answered your questions in a brief way. So please put forward questions what you are having. I will be happy to answer the next question. Thank you. Good afternoon, students. So I will be looking for the next questions. Thank you very much. So I can see some new people into the group. So actually new people into the webinar. So I will request you to put forward your doubts, the basic derivative module. So please go ahead with any doubts you are having. So I will be very happy to answer your questions. Thank you very much. Yeah, the challenge is finding the right strike price to gain maximum for the option. Right. Yeah, 1 second. Yes, why? To buy the right, because it depends on your risk profile. So suppose what I can see, the question is that what is the right strike price? So it depends. Suppose when you are buying suppose Reliance is at 1322. So you have idea of Reliance going up in next few days, right? So as you know, the delta of the option, that is the change in option price with unit change in Reliance price, becomes higher when it closes to the strike price, and as it goes above and above the option, the call option become in the money, it approaches close to 1. So it depends on your view. Like if you have a view that okay, there can be a big up move, and you actually yeah. So one second. Yeah. So if you think that okay, the kind of percentage you want to make. So if Reliance from 1320 to go to 1360, the call option that will be having in 1360, what will be the price at that point of time? Let us see what is 17 rupees, right? So 1300 is the stock is right now 1322. So suppose in 1 or 2 days this price, this Reliance goes to 1380 level. You can see that present 1300 call is running at 46. So it will be close to 40 rupees. It should be close to 40 rupees if it goes in 1 or 2 days. So it is, you have to have an idea of the kind of price movement that you are expecting. So rather than focusing of the kind of option you are going to buy, or the strike price you are going to buy, the most important thing is to find the chart pattern. So if you think that price is going to go quite higher in 60 rupees, 100 rupees, the quantum of price rise you are expecting, and the percentage gain you are going to make then you can take a call. Suppose you think that, okay, the price is not going to go up a lot, then not necessarily you can you should be going for a naked call. You can buy a bull call spread. It will go up, but it won't go beyond maybe 30 in few days. Okay, then someone, I'm not recommending anything, I'm just giving an example, academic example. So someone can think of, okay, we can buy a lower strike and go for a bull's call spread. So even if the price is not going up that much, it goes up a little bit, it stays in between, and if I need to exit in between, I make some profit. So it depends totally on the way, the price movement you are expecting, how much price movement in how much time. Based on that, you will decide. And it is always important, if you are a buyer of an option, it is always important to buy an option when the implied volatility is low. You can see the implied volatility of this option 18, 30, 19. It can go down a little bit. It is always better to buy an option when the implied volatility is low. Because if there is implied volatility, sudden up move or down move, implied volatility goes up, not only because of the price movement, but also due to the implied volatility, the vega goes up and you gain from the price movement due to the price gain, due to the volatility, not only due to the price gain. So that's how you approach the strike price. Yeah, I have a question from Wahid Khan again. How to hedge a future by put options? Question is how to calculate the right strike price for put hedging. Need entry and exit point of a put. Put hedging you are asking, right? So basically hedge a future buy. How to hedge a future buy with a put option. Question is how to calculate the right strike price for the put for hedging. Again, this depends on the your outlook of the price. Suppose Reliance is again 1322. I'm taking Reliance because this is open. So if you are going to buy 1280 put or 1300 put, I should say. So the factor is that if the price is going below 1300, you lose the put premium plus 2290, right? Or whatever may be the future price. But suppose you are buying a 1320 put. This is 25 rupees. So if you are buying this put for the hedge, if the price below 30, you are losing 3 rupees plus 2560, that is around 28, 29 rupees. If you are going for this one, you are again losing money 16 plus 23, again close to 40. So it depends on your risk return thing. Like if you think that, okay, your outlook for a stock, which in case Reliance, if you are bullish on it, can go to, because again, if your holding period is important, because if you think that, okay, Reliance will go up to 1400, if you are bullish, and if you are going to 1400 next month, but you are not sure of the time period, then next month again you have to go to this hedging, right? So what you have to do is that rather than directly answering the point of hedging, the most important factor is your outlook of the price movement and the time of the price movement. So if you think, okay, this can go quite high in the next 4 or 5 days, if you think that, then you can go for a price hedging like this. But if you think, okay, the possibility of Reliance going down is quite less, and in any case you can actually roll over it, and again next month you can enter the hedging position. Then you can go for a protective purpose, for a sudden down move. You can go for a lower strike price close. So there is no definite answer to the questions you have asked. Based on the kind of situation, based on the kind of outlook, the price outlook of the price movement, you will enter the situation. And again, always if you are trying to have a strategy, like you are going long on a future and hedging it with a put option, always try to have the payoff diagram, the payoff for various closing prices. You can do it very easily in Excel, and that will help you to understand, okay, what if the price movement is there, desired price movement in 7-8 days. Because if the price movement is there in 7-8 days, and if you are going for this put option, if the price movement is not there, then even if it is the in the money put, it goes up to maybe 1340, you gain 20 rupees, then the put loses value, maybe 10 rupees, then also you make some money. So it completely depends on your view on how you see the price movement, and that's why charts, your conviction on charts, the conviction on your trade becomes very useful. Thank you, Wahid. I answered your questions completely. If you have any further questions or follow-up questions, you can please add on. Thank you very much. Eight. Students, please put forward your questions. I will be really happy to actually answer your questions if you are having any doubt on the basic derivative model. Because last 1 or 2 questions we have been discussing a little bit technical. So if it is related to aspects of the trading in which you take decision based, the basic derivative module, also the other aspects of trading also. If it is related to, again, to the basic derivative module, I will please ask those questions. I will be happy to answer them. Thank you. Hi students, please ask if you have any questions. So if there is no questions, we will be looking to close the webinar in some time. So I request you, if you have some questions, please go ahead with them. Thank you very much. Yes, the next question is again from Wahid. What is the time frame to exercise an option? Say I exercise call option now and have a right to buy. What is the time frame given to buy those stocks? It is actually, if in India we are trading the European options on. So you can't exercise in between. There are two kinds of option. You might have read also that one is American option. So if there is a trading period, expiry period of a cycle of 2 months or 1 month, an American option can be. It is a little bit complex option, but it can be exercised any time in the life cycle. After 1 day, after 2 days, after any number of days, it is there. So suppose, but in India we are dealing with the option exercise, the European option, and they are exercised on the expiry. So as long as the expiry is over, immediately there will be time when you will be required to actually buy the stocks. So there is no way that you can, if it is cash options are delivery settled by delivery. So it is cash settled. Actually, you get the premium amount, the interesting value, that is the option. But if there is an option to actually exercise the option, you will actually get to buy the stocks immediately. You don't have to. You can't wait for a longer period of time to get them. Thanks. Welcome, Wahid. Once again, I will like to add, if you, Wahid, if you have questions you had, the previous questions, if you go to the products section and then the settlement mechanism, you will get exact exercise settlement details. Actually, it keeps on changing time to time based on the exchange. So if you want the exact details, you can go to the NSE website, go to the products and go to the settlement mechanism. The exact days, like T+1 day here. So you can read this part. You can expand and you can read this. Thank you very much. Yeah, what is the best definition of at the money option, right? At the money, in the money, and what is clear for me. So again, Wahid. So Wahid, again I will take the example of the NSE. I will show you the screen in a second. Right, if you can see the Reliance price is 30.20. We have dealt with Reliance a lot. Let us take a new security, maybe DLF. Go to option chain. So what is the current price of DLF? 0.45, right? That is the cash closing of DLF on the last day. Now 175.45. Now, what is the closest strike price of the option? You see that 25, 30 is the call price is 13 rupees. The put price is right. You can see. So these are the closest price of the present price. So these two options are in money at the money, right? But as the price is 175, this 200 call option would be out of the money, right? 140 put option will be out of the money. Again, if you can see, this 150 call, this is in the money. This 200 put is in the money. And at the money call, here you can see 13 is the price, right? If you go a little bit lower, 160 call, so I don't think this is the last traded price liquid. Yeah. So if you see the 170 again, the last price is 13. The last traded, yeah. So if you see more and more, it becomes in the money, like 150 rupees call, though I don't think it was traded or traded one or two quantity. See, the premium built up into 150, 175 is 25 rupees, so 4 rupees is the extra, right? But if you see in the money, call option, that is 13 rupees, the highest premium, because this is the premium, because in this 150 call there is intrinsic value of 25 rupees plus 4 rupees is the premium. Here into the 175 put, if you can see, the total amount is almost premium, right? Yeah, total amount is premium. Here only 45 paisa is intrinsic value because the current price is 175.45. Here the total amount is premium. But for a change, you look at 200 put, right? See, actually it is a discount. It is 5 paisa discount. Or you look at 190, you can see most of it is intrinsic value. So as they become more in the money, more in the money options, you will find less and less of premium and more of intrinsic value. But the premium is very high when you are actually at the money. These are the at the money, once I call and put. Thank you. I hope I answered your questions. Thank you very much. Yeah, the next question again comes from Mr. Wahid Khan. So, Wahid, to be answer your questions, that Black-Scholes model is the most comprehensive model. Other than Black-Scholes formula, any other method used in the Indian market, right? So, to say that in the last 2 decades, option pricing has witnessed an explosion of new models, actually, that each relies on some restrictive Black-Scholes models, right? So there are like the stochastic interest rate option models of Metro, Namin, and Zero, the jump diffusion pure jump models of Mr. Beta, Mr. Madan, and Chab. So there is again Theo constant elasticity of various models. So all these models actually focusing on various statistical aspects of the volatility and interest rate, the parameters. So not always but still till date, the black model is the most widely used model for actually calculating the option price, despite of everything being there. So most popular and most used. There are models, various charting softwares and option screeners actually provide you the option of using various models. So actually it depends on you that which option pricing model you more rely on. But globally, not in India, globally the most relied on option pricing model is still the Black-Scholes model, and it is widely used, most widely used, and most widely appreciated. It is closer to the real world in most of the cases. Because you have to understand, apart from all the parameters, what actually decides the price movement of a option is the volatility, and that is the real-time thing, right? You have to have a real-time understanding of the volatility, and volatility changes. Suppose there is a good result of Infosys that I was I was discussing. So stock is up 10%. The volatility changes. So you can't use the volatility that you were using 10 months back or the previous day for calculating the price of the option of the Black-Scholes because the volatility has changed. What I do is that there is a reverse calculation of volatility at that point of time, and assuming the volatility remains same for some point of time, because after markets open there is a option prices are down, so there's a back calculation of volatility, and with the assumption that okay, volatility will remain the same, then this volatility can be an input to the calculation of the price of the option. So that way it works out, but it is the most comprehensive and most widely used and appreciated model. Thank you. Any more questions? Please go ahead. Welcome, Wyatt. Students, please put forward your questions because we have around 25 minutes left, 25 to 30 minutes left for the. মেলগুলো দেখি তো তুমি পরে দেখছি আমি সেশন শেষ মানে কথা বলি বেরিয়ে যাচ্ছি থ্যাংক ইউ হ্যাভ এ গ্রেট উইকেন্ড yeah please go ahead we have around 30 minutes for the session left so it will be really useful if you ask more and more questions and clear all the doubts you are having please go ahead. Students, please go ahead with the questions you are having. I would request you to ask whatever questions you are having on the basic derivative module. Thank you very much. If there is no questions, we will be looking to actually close down the session. So in next few minutes, so please go ahead and let me know if there is a question that remains. Thank you very much. So if there is no more questions, we can actually close down the session in the next few minutes. Please let me know if we have any questions. Otherwise, we are going to close this session in next 5 minutes. Now it's 3:30, and we will be closing the session in next 5 minutes. Thank you very much. So are we done for the day? Because final time, I request you to submit your questions if you have any query, or we will be closing the session right now. Thank you very much. So I would thank you. There has been no questions further. So I would like to thank everyone for participating in the session, and I thank you everyone. So it was a great opportunity to interact with you and answering your questions. My name is Shodadeep, and I'm an instructor for the Present Academy. So please let me know if you have any questions or doubt. Thank you very much. Have a great weekend. Thank you. We are ending the session. Thank you.